Welcome to the Diff with John Reilly and Greg Bordelon here on the Primary Vision Network, an Energy PM's take on the world of energy investing. Here we are. We're recording on May 31st, right ahead of an OPEC weekend. So a lot in the news, a lot to discuss as we think about the ramifications of certain paths and how that could play out through the equity and investing markets. Greg, obviously top of mind for everybody. OPEC. The oil price has been weak. It's already been a roller coaster this morning. Brent is traded between a range of 73 and 71. A lot of questions as to what OPEC's going to do. I think you and I are of the similar mindset here. My thought is it's almost impossible to predict. So why not just play out the scenarios that you think are most likely to occur and seize upon any incorrect reactions or wrong narratives that may exist in the market after OPEC takes any action, whether they cut or not. Obviously, they're going to do this meeting in person, which has a lot of people in the social media world in a bit of a frenzy. And obviously, any OPEC meeting comes with big ramifications. But I'll kick it to you. I don't see any reason necessarily to play the prognostication game. I think it's more of what's going on structurally in the world and what the implications would be of a particular OPEC action, rather than trying to stake the next 5 to 10 days of P&L on whether or not they put out a number on a production cut or not.
Yeah, I guess maybe a lay of the land real quick on what's different on this meeting versus priors. I was going through my notes. What was kind of interesting is that we're like a month removed from the last shock cut of 1 million barrels a day. So it's really hard to see how that has filtered through, how it's been taken up by all the participants. We're seeing early signs of compliance from the Gulf like normal, especially Saudi Arabia with UAE and Kuwait chipping out a little bit, and the exact opposite with Russia. Little bit of echoes, not quite the dire situation, but echoes of early 20 when Russia and Saudi seem to be pursuing different paths. I don't know that we're setting up for a catastrophic meeting like we did back then, but it feels different this time versus the last few years.
Yeah, no, I agree. And I think you brought up two key points there. One, obviously the geopolitical landscape post the Ukraine invasion is probably altered. I don't want to say anything's forever, but certainly for the foreseeable future. So Russia clearly has a different agenda in many ways than its OPEC plus participants. And really the only one that matters is KSA. And KSA is making some money off this, obviously. News reports have widely shown they're buying a ton of Russian diesel on the cheap and then either relabeling it or just shuffling out their own diesel out of their new upgraded refinery system into places like Europe. So it's not that KSA has had completely missed the boat on some of these flow changes from the Russia invasion. But I agree. There certainly feels to be more divergence now than there has been over the last several years, not quite at the 2020 level. And then the other thing is just the nature of these markets. I think in the U.S., we focus so much on Cushing and almost the immediate response. The oil price is daily. There are traders swapping that out over a monthly or over a 3-month basis. There's almost an instantaneous ability at the very margin to adjust a production schedule for a refinery, to adjust what it's taking in. The OPEC crude is getting purchased months out. It's getting put on a boat. It doesn't arrive at the customer until, let's call it 30 days later, and then has to get loaded. And so the ability for OPEC production to kind of work its way through the system, as you said, is a lot less on an instantaneous basis. And we often hear OPEC talk about wanting to see how certain actions actually go before deciding to take the next action. And so given that we had an April 1 surprise cut and we're only at June 1, it's almost impossible to sit back and say, hey, this is what the effect was of the cut. Obviously, the world moves every day, and the demand picture perhaps is maybe even a little bit worse than it was in April. But it's extremely difficult to say, but the supply cuts have had XYZ effect. And so if they hold to that, you can definitely see a path where they just say, look, when in doubt, let's just punt. And if there are tensions between KSA and Russia, if there are feelings of market share gains or an unwillingness to comply, let's just punt and let's take another 30, 60, 90 days or what have you. And if by then we don't feel like Russia's complying, KSA has a more informed decision. And if they do end up complying or the demand picture changes, great. Now, it doesn't mean it's necessarily the way it's going to go, but I think you could easily paint a picture, which I still don't think will be that rosy for the world. But I still think it's certainly got to have some sort of decent probability there.
So you kind of flag the uncertainty here on timing, that we haven't had enough time to see how the last month's surprise cuts have flown through the system. Conversely, it's been 3 months since Russia promised to cut by 500,000 barrels a day, and volumes are up. What does that do? Now, maybe they don't do anything now. Maybe words get a little more heated here at this meeting. But how might this tension resolve itself over time? Say, not this meeting, the next one. How long can OPEC Plus allow the plus to go its own way?
And that's a great question, because you have to look at the end of the day. OPEC's customers are east of Suez. Yes, they do send oil to Europe, and yes, they take care of Motiva, and I know PBF buys some cargoes, but in general, OPEC is servicing east of Suez, which means it's really servicing China and India, both of whom have bought very high volumes of discounted Russian crude and are more than happy to run it and have the complexity in their refinery systems to run that crude. So it is something where OPEC always has a dynamic where it is working against its customers. Obviously, any oil buyer wants the price to be as low as possible, and any oil seller wants it to be as high as possible. There is always that dynamic. But I think right now, you really are at a spot where even with discounted Russian crude, some of the key areas, and I view that the petchem sector in Asia is the most important one for being the marginal buyer of crude, are still very weak and are having a very hard time being profitable at these oil prices. So even with a discounted Russian crude market. So right now you have a tough time, because if you say, look, I'm going to base my decision based entirely on Russia, is that going to have ramifications for the ultimate demand story in your two primary markets? And what are the carry-on effects? Obviously, tons of moving parts. No one will get every single machination right. But I think that they have to be thinking about that. And I think that that weakness which we're seeing, which is finally being discussed, even though it is really, I think, the most important thing to understand in terms of trying to figure out oil flows. But we're finally seeing banks maybe come around to this, hey, how can we have a commodity super cycle if the main buyer of this product is having a tough time making money? But I think that means there's probably some feedback. That conversation is probably happening if you're having major U.S. investment banks start to actually, for the first time, care about the difference between oil and liquids, and care about whether or not the petchem sector in Asia can actually make money, and if jamming the price up on them is actually going to have a good effect.
So your framework, which I like, is the marginal buyer is your Asia petchem producer who is struggling and would struggle with tighter margins, weaker spreads if you jacked up the cost of their feedstock and didn't do the same on their downstream product, which also makes sense because that's a function more of the broader global macro. My template for this event is what happened last time, in that you take oil production off the market, there's a knee-jerk reaction where prices rally. Last time it was a surprise one, so you got 5-6 days out of it. Then you gave back all the gains and then some, because the price strength really isn't sustainable in a weakening demand environment. So maybe I think we're discussing really just two different scenarios here. One is no cut and the other is some cut. How does it play out in either of those? They're not going to flood the market now. So Why would that playbook from last time not apply to either of those scenarios? Or why would
I can't figure out a way it doesn't apply. I really don't. You saw right away, once they did the surprise cut, a distillate market, which was already trending south, and I think would have been trending south regardless, but all the negative expression in April of weakness was expressed through the distillate and refined products market. If you do that now, you're already at severely weakened distillate cracks globally. You're at severely weakened petchem markets. You again force weakness into the product market sooner rather than later. And I think you just accelerate the time frame that this all falls apart. It's tough to really jam it through when there's no wiggle room for your customers at all. And so if you're at negative $10 roughly on fuel oil, negative $10 on naphthas, diesel margins that are in the low teens, guys are already tight. They're already tight. So I think you'd see the same thing. You'd probably get that knee jerk. Obviously, any headline, the algos are going to buy, right? We're cutting production by X barrels, unanimous, KSA, Russia agrees to it. If they can kind of get their ducks in a row to at least get a press release, the algos are going to buy it. And the market's going to buy all the E&P stuff. But I think just like last time, it's a great opportunity for a sale. And the E&P names probably would have turned sooner. It's just you also, within a very short period of time, had the XOM PXD rumor, which is just catnip for any hedge fund / algo out there to say, oh, great, cool, take me out of 50% premium. I'm going to buy the whole group. And that was sort of the double octane of that early April move. Anything can happen. Exxon can do something crazy. And I know we'll probably get to some of those things later, but I don't see how, absent that, you don't just have a very similar turnaround, because if we don't drop rigs, we're in a worse petchem market than we were in April. NGL prices are awful. Your refining market, you just passed Memorial Day, which is always the height of optimism. You just don't have all the same things. You're starting to already see. We're already selling today. Today we're going to expire. We're selling August Brent right now. August Brent has the open interest. So it's way different to start talking about changing what's going into a refinery in June. In August, you're already talking about deliveries to produce to get to September, October. You're past summer driving in the Northern Hemisphere. So it's a way different dynamic right now. If you want to start screwing with summer, you got to start doing that in February, March. April's really the latest you can do it. Now you're screwing with the fall. And yes, you can say, okay, we're getting close to the winter for distillate demand. But the gasoline demand is going to be dropping, not because of any bearish reasons, just because of seasonal demand. So I think it's just a much different dynamic right now. And, when I look at the E&P space, I'm really hesitant to say, and I've been bearish at the Permian for a long time, and I reduced a lot of them coming into Memorial Day just because of the seasonality effect, and it's already kind of worked. But as of right now, I'm looking going, are you really supposed to get that bowled up? I'm not saying you're supposed to be 100% short, but are you really supposed to get that bowled up just because you might get an OPEC cut when the petchem market and the refining market probably spits it back at you very faster than they did in April? And they spit it back fast in April.
Yeah. So one of the things that you and I discuss often is wrong or half-baked narratives. And kind of, I think what you're alluding to is an interesting one, in that so much ink is spilled talking about the U.S. side of the equation. The U.S. is certainly important. 20 million barrel a day market, 15 consumed. When we start seeing the notes and the headlines and the tweets about gasoline inventories in the U.S., near lows, and that has to be bullish. There's another part to the equation, right? And of course, I'm teeing you up to maybe talk about the inventory situation. I'm a weirdo with inventories,
as people have told me.
Yeah, so it is quite stark when you look at the inventory situation abroad versus here. And I mean, like, every region. Why What is consensus missing when they talk about low U.S. gasoline inventories vis-a-vis the entire hydrocarbon demand?
Yeah, and I think when they look at low gasoline inventories, everyone, and understandably so, because so many financial commentators live in the Northeast, and technically, yeah, it's low, but guess what? There are no refineries here. And the first place you keep refined product storage is at the refinery. And so it shouldn't be here.
Yeah.
And if you look in PADD 3, I like to think about the triangle arbitrage between ARA and the Gulf Coast and PADD 1 and all the Jones Act dodges. And obviously there's the Bahamas sitting there with around 26 million barrels of storage, which we do not get in the EIA data. Traders have plenty of places to hide things, to put things out of the data, then bring it back. There is not a gasoline shortage. ARA's been full forever. And a great example this morning, Motor Hellas in Greece is a great example of a lot of things that are false narratives. Same production, but they saw IMO coming years ago. We obviously had things stalled because of COVID, but switch your crude slate, invest a little bit of CapEx, and all of a sudden cut your fuel oil production in half and jump your gasoline production by 50%. Same throughput. The market hates to look at complexity barrels. Everyone wants to assume every barrel of refining is the same because a lot of people just started looking at refining last year. And it's not the case. And so it's really anytime you squeeze that inefficiency out, I think the number was roughly 20,000 barrels a day of gasoline into the export market just out of one Greek refiner. And so there isn't this shortage. And then you come in here and you go, okay, well, I think inventories are backwards looking. They're a function of what my inputs were 6 to 8 weeks ago and what my demand has been over that time. And the net result is just ends up in inventory. It doesn't in and of itself tell you anything. And all of a sudden, and Valero even admitted that on their call, they're as much of a hype machine as exists. And they just said, well, it's really not about demand. It's really just, we look at it as an indicator of tightness, as if, their hype machine hadn't been going since the minute Vlad walked into the Ukraine. But also with rates where they are, if you're a major U.S. retailer, why the heck are you holding on to inventory? If you're borrowing at Prime Plus at your local bank, if you own a couple, or if you're a big guy like Wawa, I'm in New Jersey, Wawa's a monster here, and Quick Check, which is owned by Musa. Why wouldn't you make Valero, Exxon, Marathon, companies 10, 20 times your size, make them hold the inventory? You're not losing sales.
They're still making it, right? They're still producing
it's still there. And Moose's not on their call going, we're losing sales to the guy across the street because we don't have enough gasoline. Casey's isn't saying that. No one is saying that. Yeah. Everyone at least out here, put cones in front of the nozzles. Everything seems to work. This whole notion that everybody's in a panic and you can't find the next barrel of gasoline when there's more than you've ever had sitting in Northwest Europe. There's plenty of it sitting in the Gulf Coast, and we've had, massive turnarounds earlier rather than later this year, and we just hit seasonally adjusted all-time high inputs in PADD 3 right before the Marathon fire. So we're gunning it as much as we ever had in our most important refining region. And we are negative 10 on naphtha in Asia. So again, to why refining may be kind of losing in every situation. And you talked about wrong narratives. This narrative is that we don't have enough refining capacity, which is blatantly false. And Lyondell certainly kicked it in the teeth this morning as well by announcing that they're going to magically stick around for 2024 as well. There's no reason for Asian producers to just not take the naphtha and throw it to a blender here. Hey, why not? The more that OPEC jams up the price, the tougher it makes it for a petchem market that's completely on its back in Asia.
Yeah.
That's going to end up here in our gasoline market. There's no reason for it not to.
So if you're willing to make the assumption that crude oil and refined products are fungible in this global market, maybe the excess inventories you see everywhere, and I mean above the 5-year band that you see in Europe and Singapore and China, maybe those will normalize and come over here where the arb is wide open, and we don't, in fact, have a shortage of inventory in the face of, I'm going to call it average demand in the U.S. and low average. And abroad, it's not. The demand is weaker than average abroad.
Yeah, exactly. It's
except where petchem is decidedly weak.
And I think that's the toughest when I think about what we see a lot over here in the U.S. The biggest thing missing from the dialogue on energy is Asian petchem. And why? Because it's in Asia. And in the U.S., our refineries have deconsolidated from the petchem world. And we've got a chemicals business that is viewed separately, which the hedge fund business is usually siloed in the industrial side. E&P analysts who take this bizarre, perverse pride in not knowing anything about refineries and petchem. And so it kind of all sits in these different pockets, and you go, okay, oil demand. Well, oil demand, again, on the BP stuff at the end of 2021, refined products demand was really 77 million barrels. Everything else is naphtha and LPGs, which is going into petchem or other specialty products, which means the oil barrel is competing with any propane cargo on the water, any LPG cargo on the water. And so if you show up with a barrel of oil, you now have to oversupply fuel oil, which has been a negative kegger for over a decade. You have to oversupply every other market. And your ability to do that dictates whether or not it's okay to show up with another barrel of oil. And obviously infrastructure and what everyone can receive and what the export potential is of every market. So I really think everyone loves to say oil demand, and they mean liquids demand. And, you know, you look over here, EIA, we had 21 million of oil products demand. No, you didn't. Oil refined product demand peaked in 2005, I believe, 2005 or 2006.
Yeah, petchem dries about it has been for quite a while.
There's a couple million barrels of ethane in there every week, and everyone says oil products. It's not. Refiners had nothing to do with that. None. And so we're really at the point, and I think the oil bulls have been frustrated because they just want oil to be oil. They want each refinery to be the same. And they just want, I need 100 million barrels. I'm short a little of this or I'm long a little of that. My oil should be at 150. And there's not 100 million barrels of oil demand. And I hate to really break it to the people that think there is, but there's not. And so if you're investing in shale, if you're investing in the North American energy complex on the belief that there is a limitless demand for oil, that is a massive false narrative. And the reason this keeps failing is last June, when energy had one of the worst months we've ever seen, I think it was Bespoke said it was the third worst drawdown they've in their data set over, I think, 50 years for 1 month. And that naphtha crack just went, you could just see the petchem buyers in Asia just go gone, and the bottom fell out instantly. And the algo sniffed it out. And in the U.S., everyone's saying, but my refineries are, and it's like, oh God, no, you guys are missing a bunch of stuff. Now, obviously, the equities recovered and had themselves a party, even though the price kept going down. But I think that's what they keep running into, is that false narrative is actually caring about what's oil and what's liquids has mattered in 2023. It didn't in 2022. In the physical markets, it did, but in the equity markets, it did not. And the equity markets are just catching up to the physical markets in, like you said, that false narrative of like, what's oil, what's liquids? What do I need to incentivize? What does my infrastructure allow me to incentivize? What's what? When propane WTI is at 0.35, you're going to have a lot of things pulling that oil price down. Any propane cargo that's on the water that can go into a PDH facility in China, that's going to get a much better bid than the marginal oil barrel, because I don't have to worry about any fuel oil or anything like that. In 2021, 2022, when we're just coming off pandemic lows of production and we enter into world geopolitical conflict and propane was at 0.8 times WTI, yeah, oil looks pretty darn good. Because the problems of taking it relative to the problems of buying exactly what you need are much, much lower. And we're at a point in the cycle, I think, where the equities are trying to figure out where the marginal problem goes. And I keep coming back to U.S. refining as kind of, I can't figure out a situation in this, like we were talking about, like that false narrative that there are not enough refineries, which, I mean, every day someone realizes that something's opening in the Middle East or something's opening in Asia. We had an official 400,000 barrel a day heavy oil refinery opening in China yesterday. Like I said, a lot of the stuff from IMO that had been getting done that had to go on pause from COVID is showing up now. The world is not short refining capacity, and it's coming on at ever increasing levels of complexity. So you take out a tiny little crappy single digit complexity refiner that is not an equivalent barrel to a teens in Asia fuel oil to petchem, can take any grade under the sun, built to handle anything refinery. And that is causing a tremendous amount of pain, I think, currently and going forward for these earnings streams. So I look at what OPEC can do. I don't see a way out of it for people that have invested heavily in this, perpetual refining shortage thesis.
Oh yeah, I think the market is slowly getting beat over the head with these announcements once a week about either capacity that's been under construction for 6 years coming online imminently. You've had China open their latest 400 KBD. You've got Al Zour coming on in phases. It was down earlier. It's back online in Kuwait. We got Lying Down now that's going to stay online. I agree. It's going to take time, but I think that's starting to show up. So then I'm inclined then to fade any kind of strength really coming out of the OPEC meeting, unless we just kind of go in walloped and there's no residual equity value into the meeting. But that apart, I would want to fade strength and play defensive. I like to do larger cap, larger balance sheets, safety names on the long side, and then take a couple shots on your more marginal guys on the short side. And that's kind of across the subsectors as well. I don't know if you think about it differently. I know you all like to play the low delta options and there's more. How do you?
Hey, playing options this year for the first time in a little while has been a nice place to be. And we're not going to turn this into a macro call, but I guess we can thank the zero DTE guys for keeping volatilities relatively low, because Lord knows the earnings streams for energy companies are never low volatility. So it's nice to get that mismatch. I tend to agree. I've been, all things being equal, relatively bullish on the integrated guys. Because I think that even though they're not in a quote unquote good spot, they're in a considerably less bad. Part of it is the balance sheet, as you said. There's always going to be, as this zero sum game plays through, there's always going to be winners and losers. And the timing of that and how that goes is not always certain. But like in Exxon, even though I know it's overowned and it's on everyone's favorite list, but at least, okay, well, if this month refining does actually have a good month, they've got that. If petchem somehow turns around, they've got that. If Brent wildly outperforms TI, they've got that. You've got production growth. You've got are earnings going down? Probably. But you have a much, I think, more stable stream, and integrated business models, while not as exciting because you don't get leverage to a particular thing, regardless of how it trades. But in terms of the earnings stream, there are benefits to it. And I think we're certainly in a period right now, I think that will last probably a couple years, at least until, 4 or 5 years from now, when a lot of this new refining and petchem capacity is finally on and the world can kind of go. While this capacity is opening and introducing itself to the market, I certainly think they're in a much better spot. Where I've been wrong and early, but I still think it's going to work, is natural gas. Man, it has tanked as it should, and I wasn't a bull on natural gas, but I definitely think everything we're talking about means that the rig count's got to go down. The U.S. is wildly overproducing, in my view, and so there is that when you look at the Marcellus names, which everyone loves to short, they're the only ones not over-convexing. They're the ones not overproducing. And obviously, the MVP announcement may change some dynamics, but in general, the Permian is the primary abuser. They're incinerating capital, especially out in the Delaware. NGL prices are terrible. Gas prices are terrible there. They're capacity constrained, and if they keep this frac and rig count up, they're going to eat through new egress capacity as soon as it opens and be back in a terrible spot.
Yeah.
So when I look at it, I go, man, I kind of like that dynamic. Clearly, though, the market has had a brief moment where it cared, and the physical indicators have stayed relatively okay. But obviously, with this MVP announcement and then just the general hatred of all things energy in the last couple months, it's been a little bit early on the turn there. I love them as a long against the Permian shorts, but in and of themselves as standalone longs, it's certainly been it's been early there. It's tough now, especially if MVP is going to stick another 2Bs into the market. Even though I think that benefits the Marcellus, that's obviously, as Hub goes, sentiment goes, at least in the very short term. And so if Hub doesn't want to absorb that readily, and again, assuming it goes through, we don't know if the debt ceiling bill will go through, but assuming it goes through and that the workarounds they've instituted actually occur, that basically takes care of the Haynesville ring drop and them some, and that means we just have to have even more pain in the other basins. So,
well, I would contend that the MVP announcement actually should be a tailwind to your long Marcellus short Permian trade, in that I don't think that the 2Bs of capacity that MVP would have will be new. That's not new gas volume. It's going to show on the market.
I can't imagine it would be.
But it's certainly not overnight, right? Like that, if they turn that thing on, it only has another couple months of construction. It's 94% complete. So let's say it gets blessed, Corps of Engineers approves it, then maybe it gets online by year end. I cannot imagine the guys who have been keeping production of the Marcellus flat for 3 years now are going to start throwing rigs up there in anticipation of MVP coming online while gas is flirting with a one handle, right? I feel better about Marcellus here, in that it should benefit them. And I think those guys are actually the best at capital discipline for the time being.
I would agree. The market certainly didn't agree with that yesterday. But yeah, I mean, right now, I'm just looking, if you look at EQT as the primary source on that pipe, M2 next year, the strip is 251 on a flat price. So is EQT going to all of a sudden say, hey, at $2.50, we're vacating 2Bs out of this basin. Let's just assume we did it all at once. Are we going to all of a sudden call up Halliburton and Patterson and say, we need 4 rigs and 5 frac crews at $2.50? I don't think so.
Well, they told you, right? And at least we can take their word for it, because they've been operating up there in that manner for the last few years. All of them, all of these guys.
Exactly. And that
now we should pressure, as we were talking, if you're going to send another 2Bs that's going to compete with Southern gas heading up there, it should pressure Southern gas realizations, which are telling you right now there's too much gas in Texas and Louisiana, which is why you keep growing rigs in the
Exactly, man. I agree. Obviously, the market's reaction yesterday was kind of negative across the board, and obviously it was an energy tape red day. So to the extent that any of these names, which they all are, they're all in ETFs, they're all in XOP or XLE. And so if there's macro pressure just pounding the ETFs, it's really hard for anyone to pop their head up and be green. But in a tape where oil was extremely red, Hub was red, so they were red. But I do think that it actually is net beneficial for the Marcellus, because that is clearly going to displace gas that is coming up through the pipes. That null point on Transco, which has been living around North Carolina, it should push it down further and further south. Now, it's a whole new question as to what happens to that gas, because that southern connector that they had been planning on building into North Carolina does not exist. So it's going to show up at Williams' doorstep. And I think Williams is probably just going to have a field day with 2Bs just saying, hey, here we are. And, regulated buyers who are, all things being equal, price insensitive on one side. That gas is going into power plants for Dominion and Duke. And that's why it's there. It's not Texas. It doesn't have petchem and refining and all these things. The south central part of the East Coast here it's for power gen. And so that means the buyers are largely regulated or IPPs. And Williams is going to be able to work with them and really have a lot of fun on the diff market down there. But that's a separate problem entirely. I think, yes, even if you take a bit of a bath on what you realize down in non-New York, you're going to more than make up for it as long as you don't completely drill your brains out in the Marcellus. So not a fun situation, but when I look at natural gas equities pricing off of $2-3 gas, and then I look at the Permian and I look at, what CVX paid for PDC up in Colorado, and I look at NGL prices and everyone telling me these are oil companies. And I'm like, are they? Because they really don't look like oil companies, and they certainly don't look like oil companies in 5 years when you project out as you run decline rates through. It looks like the best risk reward. Again, everything in energy is always relative. And so I understand why people have been avoiding these stocks all year. But as of today, I looked at yesterday and I said, this is probably not a bad time door to door, especially if you're running a book on the other side, which I've been very negatively biased on the Permian stocks. I think it's got a lot of nice angles to it. So risky, understood. I would never say make this a massive, huge position right now because we have a lot of pain to go. You need to get the frac count and the rig count down a lot from here. But I do think it sets up nicely. And the enterprise values are just so small. And I've always loved that dynamic when the street wants to be long guys with 30, 40, $50 billion market caps and short guys with $2, $3, $4 billion market caps. It blew up the guys in tech. It always blows up the guys in energy. They want to pretend that all the gas problems in the world can be expressed through the Marcellus, and none of them are going to be expressed in the Permian. And I think the gas NGL problems in the Permian are going to be way worse the next 12 to 24 months than what we see in the Marcellus. And they've CapEx and buyback themselves to death. So what are you thinking on that? What are your kind of thoughts on the?
Yeah, I agree. I mean, the oiliest of the Permian guys, who are ostensibly your oily E&Ps, is 50%. And that's only by playing a little bit of three-card modeling with M&A.
Absolutely.
So if the oiliest you can get is 50%, that means the other 50 is gas and NGL. Gas generally exposed to Waha, which is the worst gas price in the U.S., about to get worse with MVP. NGLs now, I don't know what your indicator is, but mine this morning was you're down to $17.
Yeah, if you had an ethane, absolutely. It's a disaster.
You were in the 40s last year. So the realizations in the Permian now have completely lapped everything in the last year. You are worse off than you were a year ago. I agree. I think the revisions momentum is decidedly against the Permian guys who are trading at more elevated multiples and a lot of downside here.
And have been growing debt and share count. I mean, talk about, as we all suspected, but a new generation of investors bought into hook, line, and sinker. There is no maintenance CapEx. You grow or you shrink. There's no magic level. And every 4 years, the street and a new set of investors like to say, hey, if we keep CapEx here, we'll make X a year, and then I'll create a bond for myself, and we can dividend and we can buy back, and buybacks aren't returned, but that's a separate podcast. But we can do all this stuff. And it's like, yay, amazing. I'll buy all these Permian guys. It's like Devon's a mess. Devon just nuked themselves. I guarantee you every Devon shareholder would love to have that money back from the buyback. Fang's share count is higher because the only reason they grow cash is they have to use their cash to do M&A. As you said, they're the kings of the three-card Monte game. So you've got all these guys. Pioneer is dividended out. Everything. Their debt balance is ballooning.
Yeah. All three of those have been adding net debt and returning more than 100% of free cash flow. And I checked in Excel. It's just not sustainable.
Did you hit F9? Do you have to hit F9?
I did. I had to make sure.
If you hit F9, the thing is worth $487. You need to hit F9.
It is a problem that the market has not internalized. If that model doesn't work, and you have so much in the way of headwinds now on pricing that is not.
Yeah, they
factored into.
It's the standard stuff. They all levered at the top, and
yeah.
If you didn't sell into that buyback, you're now sitting there owning something with a higher share count and a decreasing dividend that now has more debt into a price deck that's brutal. That's awful. And, that wasn't sustainable. They're over drilling. This whole thesis, well, we'll keep drilling under control. You didn't. And the propane WTI ratio, your NGL indicator, I track that SBI. I traded Delaware proxy. It's right back to where it was in 2019 when everyone was incinerating cash. And yes, costs maybe have peaked on the OFS side, but not nearly as much as you've lost over drilling. And you're going to have to,
on the revenue,
and you're going to have to continue this frac count, or you're going to decline. Because you ramped it up, and investors never want to admit that that's the way it is. So
that's right.
If I'm sitting here, I'm scared to death. Their ability to capture, as you said, with gas and NGLs where they are, you capture less and less of an oil move because you have to take such a discount on a BOE basis. I look at the differential, and right now it's around $32. So my shale index is at 37, Midland's 37.5, my Midland's roughly 70. So you're losing $32.5 to Midland. So if Midland goes up 10, you're not getting 10. You're just not. And so it just becomes harder and harder. The enterprise values are too big. But you're praying for a bailout. But again, I know you did some good work on the CVX PDCE energy merger. You had that PXD XOM thing. Really, you're kind of just hoping one of the big guys does something crazy, but they've never bought everybody. So if you're not something crazy, that PDC multiple is brutal. And if that's the right multiple, these guys are all dead.
Yeah, they're all overvalued, which is a staggering thing to say. Yeah. If PDC went out with a mere 10% premium and still only got to 3 times, it is brutal. And the implications are brutal for the space as well. And Chevron, if you go through the slide deck, Chevron slide deck, they're just notoriously short on these large multi-billion-dollar acquisitions because they can be. You remember the Reggie one, but the second slide of the Chevron deck for PDCE, it was talking about accretion. That was it. Chevron had expensive paper, and they used it to buy cheap paper. They were buying cheap cash flows, and they didn't have to pay a premium for them. The most interesting takeaway in my mind was that they wanted an asset that was a complementary bolt-on to their U.S. presence. And they are huge in the Permian, you've no doubt seen. And they went to the Niobrara. And they went to the Niobrara because it was cheap. A long way of saying, if you got a higher multiple in the Permian, a takeout probably is not your best way of monetization at this point. And that's kind of nuts to say.
Yeah, not at these enterprise values. I think you've got to get a huge reset. I don't think you're getting taken out. Again, anything can happen, and big companies have done crazy M&A deals. And so it certainly doesn't mean XOM doesn't have something up its sleeve right now. But just I said in February when we were talking, in April, I would think, especially they tend to compare each other to themselves. If you're looking at what CVX just did, you're Exxon, you're going, this forward outlook sucks. We're growing like crazy international. We're CapExing in the Permian. Why do we have to pay for somebody else's CapEx? Now, they've done it in the past, but remember, they got burned on XTO. They wildly overpaid. And
for 10 years, they remember that. They got
there's still people that bring it up that probably weren't even alive when the deal happened, And so you look at it, you go, why don't we just let this stuff fade as much as possible? They just spent a ton of CapEx. They brought on brand new chem facilities with Sabic. They massive Beaumont expansion. It's time to harvest cash flow there. They're paying money in Guyana to build a world-class asset which the market justifiably loves. Is probably the best asset right now in terms of the free world. And so are you supposed to pay PXD $300 for increasing debt balance and a shady GOR? Probably not. Let these enterprise values collapse again. See if any of these guys capitulate, see if they merge, scoop them up. Now, again, that's what you and I would do. That doesn't mean that's how the C-suite at Exxon would do it. But, if you're looking to your point, if CVX just paid 3 times, you don't want to walk up to the shareholders you care about, which are the guys in Boston at the mutual funds. You don't want to go to Fidelity and all these guys, the life insurance companies that are going to hold your stock for 100 years. And when they go, well, Chevron just came into our office yesterday and they said they're paying 3 times for acquisitions. And now you're sitting here telling me you're paying 5 times? And you just don't want to hear that if you're the management team at Exxon. It just seems to be the way they operate. So if you're looking and PXE goes, hey, by the way, you could have us at 6 times, like, okay, great. 6 times trailing, it's really 12 times forward. And Chevron just paid half.
Yep.
I just don't see.
I agree with you. Like anything could happen. These guys could make any silly acquisitions. And I'd like to think that history has taught them not to touch that hot stove twice. But if nothing else, this precedent de-risks that likelihood.
Yeah.
So if you're an E&P and you're trading in the ballpark of 3 times, that's about fair value. You're not going to get it much more because there's only a handful of buyers at this point anyway.
Yeah.
And if you're trading above it, well, it's going to be hard for you to get taken out without some like really exotic story. And most of these guys don't have it. Most of them are in maintenance mode without a lot of inventory upside.
No. And the GORs, like it. We talk about shale as if it's been 100 years old, but it's still relatively new. Obviously, a lot of these companies have been around for a long time, but shale kind of pedal to the metal is less than 20 years old. And in oil, it's really less than, for any intents and purposes, 15 years old. So, we're just now, because of all the stops and starts, getting to the point where this GOR math is really starting to mess with the numbers. And the reserves are getting gassier and gassier. The NGLs are getting more and more. And the ability to fake being an oil company, yet we have revenue and EBITDA multiples, which take into account trailing oil barrels, GORs going the wrong way. And the other thing that no one talks about, because no price quotes on our screen, is just the amount of water that gets taken away now. So you're getting more and more barrels of water that need to get taken away per unit of output. Across the board. That's every basin. So the math is just getting tougher and tougher, and the enterprise values up at this level are just tough. And it's hard to say, we just don't need a reset, and we've got to start trading these companies off multiples that are more akin to what they produce, an MMCFE multiple or something like that, because you can do a lot of things to fake an oil cut for a couple months. And like we said, Diamondback's the world leader in the ability to do that. But for a lot of these companies, the reality is the reality. And you're going to have to care about the oil price, the gas and the NGL price. And it's become, again, a wrong narrative. Oh, oil's all that matters. We like to joke a lot of times about things that sound bullish but aren't. 90% of our revenue is actually oil. Oh, that's awful. You're short. If you're saying something like that, you're a short, you are dead. You are
40% of my production stream, but 90% of my revenue.
Exactly. Oh, guys, 60% of what I make is worthless. If that's your bullish narrative, congratulations, guys.
This is actually a great segue. I was mentioning to you, I was on a call with senior executive from a large Permian company, and he was getting pressured with questions on Waha. And this guy makes not quite a B, but they make a lot of gas in the Permian. They're getting just over a buck for it. And so the question is like, why do you keep doing this? And they said, well, we're making money on oil. That's where we're making our money. And our natural gas break even for the whole play then is derivatively, it's a negative number. Negative 10.
It's like we're back in 2014 again. I miss those decks.
Actually, it is. So I'm sitting here like, you're telling me that you are actively losing money on gas and likely NGL because you are kind enough to disclose your field OPEX. And you're disparaging the guys in the Marcellus who have been maintaining production flat for the last 3 years and generating profits and free cash
reducing
flow
debt
while doing it. And reducing debt. And you're incinerating cash flow in the pursuit of oil. Every barrel of oil you produce makes the other 50% of your production stream worth less and less and less. I mean, it's all bad.
Oh, it is.
It's all bad.
It is. And, every conference season, earnings call season, when you and I are comparing notes, and I've always liked to listen to the refiners and the midstreamers a lot more than the E&Ps. I feel like the E&P is just kind of whatever the refiners and the midstream decide is what E&P ends up being able to enjoy. And so when EPD last year would start talking about how Waha gas prices were a gift, they're going negative, they're going to be negative in 2023. I mean, there's only a few guys who get to decide the gas price in Texas. EPD is one of those guys. And if they're on a call and they're telling you that in a way that almost sounded angry, that they're mad that gas prices were high and that they're going negative next year, and they're seeing rig efficiencies go up, frac efficiencies go up, and you still okay a depending on who you are, anywhere from $3 to $10 billion CapEx plan in West Texas, I think your ability to hold others accountable and blame them declines pretty quickly. And, one day maybe these guys will figure out that they're supposed to drill to their weakest price and let that govern the drilling plan. But that certainly didn't happen during Shale 3.0. It probably won't happen during Shale 4.0. Maybe in 50 years, there'll be two dudes talking about Shale 50.0, and these guys will finally get the joke. All right, man. Well, listen, I think that this has been helpful. I think, I think the takeaways, obviously, not trying to be overly bearish, but we think Shale has kind of obviously nuked itself again. We think the refiners in petchem are in the toughest spot, regardless of what OPEC does. And I think the takeaway, Greg, tell me if you agree with this, is that this OPEC meeting is going to be an accelerant if they decide to cut, is an accelerant rather than changing the general direction. I think we see weak petchem, tough refining markets, and it's a question of how quickly does the pain get shot into that market. The last cut accelerated the pace with which refiners in petchem took pain. Another cut probably just does the same. And ultimately that top down through the E&P space is what's going to happen. We're just talking about pace, not if.
Yeah, there's a natural destination. They'll dictate the path we take, but I think we both know that it's going to go lower while the commodity weakness persists, right? There's a demand problem, and we just got to get there.
Yeah, exactly.
And then it's a cycle. Then it'll come back. But now is not the time, I think, to go long risk in the space.
Yeah, no, I would agree. All right. Well, listen, this has been the Diff on Primary Vision Network. Thank you guys so much. Please subscribe, do whatever you can to Primary Vision Network. I'm John Reilly. This is Greg Bordelon, and we hope to see you soon. Bye.
All right. Thanks, Sean.